All right. Hi everyone. Thank you for being here today. So my name is Kwon. I'm the vice president of Stanford Blockchain Club and founder of the Stanford Blockchain Accelerator Program, where we incubate the top crypto native projects out of the Stanford ecosystem. Today, I'm very excited to have Kwon, co-founder and CEO of Terraform Labs, and Natalie Liu, head of ecosystem development at Terraform Labs, joining us today to share with the Stanford students and the broader Stanford blockchain community everything about Terra. That being said, I will pass on the mic to Natalie to kick off the event.
Thanks, Kwon. Great to speak to everyone here today at Stanford Blockchain Club. Some of you may know, but I'm a Stanford alumni, did material science undergrad and MS&E masters, graduated in 2015. Since leaving Stanford, I mostly worked in venture. So I worked at Y Combinator for a few years when they were building out their accelerator and university ecosystem, and then also spent time at Lightspeed as a partner where I was doing fintech and crypto investing. And one of the investments I made was in Terra. And after spending a ton of time with the team and spending time with Do, recently joined Terra less than 2 months ago to spearhead ecosystem efforts. So really excited to be here. And with that, I'll hand it to Do to introduce himself.
Hey, thanks, Natalie. So hi, everyone. I'm Do. I was computer science 14. I spent the last few years working on various different things. So out of college, I worked for a big tech company. And then during that time, I was just working on side projects full time, doing nothing, as if it was COVID. And then so I started a networking company in mesh networks. So the idea was that you could connect user devices over Wi-Fi direct and Bluetooth, so that even if you don't have direct internet connectivity, you could hop through a network of other users around you to get free internet access. While we were working on that technology, as you enter search queries for mesh networks or distributed networks, things like Bitcoin and Ethereum tends to pop up a lot. And then, so that's how I sort of fell down the crypto rabbit hole and then started to think about what are some of the ways in which we can construct better currency, specifically designed for a decentralized internet. And that's how I got the inspiration to start building Terra in 2017.
Yeah, maybe we could start with a high-level overview of what Terra does. So at a high level, Terra is a blockchain that powers decentralized stablecoin UST or Terra USD. And through various dApps that have been built on Terra, such as Anchor and Mirror and Terra Station, as well as real world applications like the Chai payment app, over 3 million users have been able to interact with the Terra blockchain. And we're at a point in time where Terra as a blockchain can power many more apps and primitives that can exist on Terra. Some of those examples of the ones that exist are Anchor, where you can deposit UST for 19% APY, which is a lot more attractive than your banking savings rate of roughly 0%. Another is Mirror, where you can trade synthetic assets and get price exposure to real world assets like stocks. And another protocol that launched this week was called Prism, where you're able to split the principal from interest in a proof of stake asset. So that said, Do, what is a long-term vision for Terra, and what is uniquely possible to build on Terra as opposed to other blockchains?
Got it. So I mean, I think there's a couple of angles to this. The first is, I think Terra is one of those blockchains that are uniquely focused on trying to build a better currency. So what was kind of interesting is, this was true in 2017 and this is true today, that most builders in crypto are focused on building better applications. So like a betting app, or let's say an NFT marketplace, or building better servers. So systems that are either faster than Ethereum or more private. So some value additive feature that's being built in. But there's very few people that are trying to build better currencies, right? And that's sort of like the unifying thesis of the entire ecosystem in a totally undirected and decentralized way. That in some sense, all the different apps that are being built on top of Terra, add Windy and add usefulness to Terra USD, the stablecoin. So it's as if like by building payments applications that leverage UST, or building an options protocol, or by building an AMM, or by building NFT exchanges, all these applications work in tandem to reinforce the usefulness and adoption of Terra USD. And I think that sort of philosophy and that sort of synergy is what makes the ecosystem unique. In the sense that by building a bunch of applications, you create a digital dollar that is more decentralized and useful than anything that exists in the world today. And that's why the Terra community and ecosystem, in my opinion, is stronger than most others.
So Do and I are actually in Singapore right now. And one of the coolest things about Terra is it's a global community, and there are these Telegram chats called lunatics. So there's like SG lunatics and lunatics in the Bay Area and elsewhere. And it's interesting that a lot of people who have Luna, who use Terra Station, other dApps, they're literally lunatics. Like when you talk to somebody in the lunatic community, as opposed to, I don't know, someone who has Ethereum, like it's a totally different conversation. So highly recommend you speak to other lunatics, and you'll get a sense for how that is. Another fun fact is that Terra is actually the second largest chain in terms of TVL. It has 15 billion in TVL right now, and it's second to Ethereum. So I think with Terra, there's only about like 15 to 20 projects that have launched on the blockchain, with about another 100 in the works that should be launching in the next year. But it has the second largest TVL and millions of users. So it's a really great community to build on, and it's pretty much a greenfield opportunity for future builders who want to build new protocols. And because we're talking to Stanford Blockchain Club, many of you are obviously very entrepreneurial and are thinking about building stuff on the blockchain. So question for Do, what are some areas you think Terra could see more projects being built for the audience here?
Got it. So I think there's a number of areas that are quite interesting. So the first is, I think in DeFi, the interesting opportunity is that so far it's been mainly collateralized lending in the sense that DeFi has acted as, it's offered a lot of different permutations by which you can leverage on your existing assets, borrow money, and use that to speculate on other things. I think where things are starting to get really interesting is that you're starting to get this notion of credit or loyalty on the blockchain as on-chain analytics history builds up. And that, in addition to sort of fully automated labor markets that DAOs can unlock by purchasing the productive hours of developers and other contributors, you can now facilitate under collateralized lending in such a way that makes DeFi productive capital markets. So I think figuring out ways in which you can facilitate some components of this, leveraging on-chain data to form some sort of credit history or willingness to pay on-chain, and then creating labor markets on top of it so that people can freely sell their future productivity to either take out contracts or to build interesting things in ecosystems. I think that's also an interesting area. I think sort of another opportunity is to come up with ways in which you can have sustainable game economies on chain. So I think the first generation of play to earn games were really interesting. But I think what a lot of the game developers neglected to think about is if you sort of add, if you remove capital controls and add a lot of liquidity for play to earn games, but the problem is that while everybody is playing to earn, there's very few people that are paying for that money to be distributed out. It's you sort of lead to unsustainable economies in which a lot of these games collapse in lots of different cases where they can collapse a lot faster than Web2 versions with tight capital controls that are built in. So I think sort of a winning model would be something like a MMORPG game with some of those sustainable economics built in, such that there is a balance of people with a stronger time preference with a shorter time preference that are willing to pay for hours, and people that are playing to earn.
Thanks, Joe. And I think those are just some of the ideas that, I mean, if we had this talk going on for hours, I think we'd have even more ideas to talk about. So in terms of future builders that want to build on Terra, there are a few things that we're actually doing within Terra to help builders learn about Terra and have the resources to build projects as they are interested in doing so. The first is educational resources. So quick plug for Terra Academy, which is academy.terra.money, where you can see how to code in Rust, program using COSM-WASM contracts and using COSM-WASM libraries, and how to test and deploy on Terra. The second is community. So last week we had a Hacker House at Miami Hack Week, hosted about 30 developers who wanted to build new ideas. These are some of the things that we're going to start to do in the future. We want to be able to gather people who want to build, have them interact with each other and help each other build projects. And lastly, we will be assisting more with kind of accelerating new projects in the community. So there may be various, either accelerators or, we partner with Stanford Blockchain and other groups who are working with future founders, and we would work closely with those teams to try to get them off the ground. And switching gears a little bit to like more of these real world applications. So in addition to DeFi or decentralized apps that can be built on Terra, there can also be a lot of real world apps like Chai to be built on Terra, or use Terra primitives in some way in like consumer or B2B fintech use cases. Doe, could you talk a little bit more about some of these real world applications you think that could utilize Terra?
Yeah, so I think basically the most exciting thing about having programmable payments is that it sort of expands the design space for things that are possible. So like one of the things that one of our portfolio companies called Subera is building is that instead of paying directly for subscriptions, they figured out a way whereby a user just needs to deposit stablecoin into a wallet. And then on aggregate, those stablecoins generate yield based on DeFi structured products like Anchor Protocol and some others. And then the yield coming to all those user deposits, the founding team uses to negotiate preferred subscription agreements with guys like Spotify and crypto native firms like Nansen and Delphi. So the idea is that you can sort of bulk purchase a lot of subscriptions based on the things that users like that are powered by DeFi yields. So you can just like keep a bunch of USD in a wallet, and then you'll be able to get like, let's say, a Spotify subscription or whatever it is that people buy using subscriptions. I don't buy too many things. A second thing that's interesting is there's a lot of programmable payments that are happening on sort of like a nation state or municipal level using smart contracts and payments. So for example, during the COVID pandemic, there was a city that we were advising that we're giving about like $1 billion in COVID relief every quarter. Now, the problem with this was that when they were giving out COVID relief, people were just taking that money and using it for really unproductive purposes, or spending that money outside of the immediate regional economy, thereby limiting the economic impact of the subsidies in general. So one of the things that they wanted to do is that once a subsidy is given out, that those payments be be only usable in whitelisted merchants and service providers in the regional economy, to make sure that the money is being used to benefit those that are most impacted by COVID. And number two, to make sure that that money stays in the regional economy so that it can keep benefiting and revitalizing the local economy. So I think there's lots of different use cases that you can build on top of just payments and real world use cases that leverage the programmability of Terra smart contracts.
Thanks, so. Yeah, and actually, if you want to visit more like other learn about other projects that are utilizing Terra, we have like a website with all the projects. But like Do mentioned, like, you know, if you think of Stripe as a platform where there's a bunch of different building blocks, let's say there's, you know, the actual Stripe payments and then Stripe checkout and Stripe billing, and maybe like 10 to 20 different products that Stripe offers. Think of Terra as like the decentralized version of that, where if we have UST as a means of payment, a decentralized form of payment, every building block that powers a larger payment platform, essentially like Terra can be that, but has a few of those slots filled with potential projects that are building for yield, building for programmable payments. But there's a whole host of things that haven't been built yet that can use Terra. So I think about it as, you know, what Stripe offers and probably more than that too. The last question I have for you, Do, and then I'll hand it over to Kwon, is what are the pros and cons of algorithmic stablecoins versus centralized stablecoins? And what's a long-term vision for UST?
Sure. So I think there's a lot of nuance, you know, that separates centralized stablecoins from decentralized stablecoins. But I think the main distinction is that, well, algorithmic stablecoins are decentralized. So the idea is that, you know, for stablecoins like USDT or USDC, there's a dollar kept in the bank account for every unit of stablecoin that's issued, which is great, except that the underlying bank deposits can be used as collateral to get the stablecoin issuer and the apps that are built on top to do, you know, to do whatever it is that, you know, the people in control feel like they can do. So basically the idea is that, like, if you build a DeFi ecosystem on top of centralized stablecoins, the entire ecosystem is held hostage to whoever feels like they have control over the underlying bank deposits. So it could be the banks themselves, it could be the regulators of a single nation state that has control over those banking reserves, or regulators of people that you know, have control over the individuals that are in control of those reserves. Or it could be like the individuals themselves that could just like fly away and run away with the money. So whenever you have centralized points of failure, there are lots of issues that don't inspire confidence in building a large decentralized ecosystem of financial apps on top of it that can control, you know, tens, if not hundreds of billions of dollars. And I think that's the problem that algorithmic stablecoins solve, in the sense that before the ecosystem is mature, the slippage costs of trading in and out of algo stablecoins is going to be more expensive. The peg volatility is going to be higher than what you find in centralized stablecoins. But in exchange, what you get is that sort of decentralization purity, in the sense that there's nobody that can freeze your assets once it's in a smart contract. There's nobody that's going to be in control of how you use your assets. The assets are going to be fully self-sovereign. It's going to be yours, and it's going to be fully programmable without any restrictions. So I think that's the, you know, the promise that algo stablecoins could potentially bring. And I think, you know, Terra is a really interesting project because it's the market leader in that category of decentralized money. And, you know, whatever you choose to build on top of it can make it even more decentralized and more useful.
Awesome. Thanks, Do. That's all I've got. So Kwon, I'll hand it over to you.
Awesome. Thank you, Natalie and Do, for the questions and answering all the questions. So now open the floor for a question from the audience. So go the question that we have in the chat. And also in the meantime, even if any question you want to ask a live question, feel free to raise your hand. So I'll give you access to unmute yourself and ask a live question. So first question we have is from Luis. He's wondering about some potential risks regarding like regulation and stablecoin, and your view of like whether like the possibilities of having a project be able to issue stablecoin independent of central banks.
Got it. So one thing that we need to clarify about Terra is that there's no centralized issuer. So the Terra network is run by node operators that have nothing to do with us. We just write code, and we're researchers that try to make the system more robust. but the entire schema is being run by a globally distributed set of nodes that are not affiliated with any centralized entity. Number two, anybody can be a Terra issuer. So anybody can burn $1 worth of Luna and mint 1 Terra USD. So from a legal standpoint, there is no centralized issuer of this stablecoin that you can attempt to regulate. Now, what they can potentially do is threaten to fine us, or threaten some sort of like civil or criminal action against Terraform Labs. But like even if they tried, like there's no threatening Terraform Labs that could compel us to try to shut down the network or try to change the rules, because that's not in our capability set. And I think this is a major advantage that uncollateralized stablecoins like Terra has over something that has bank deposits underlying the coins. So I think from that perspective, it's a lot more robust from regulation. One thing that I think could be potentially interesting is that even in this macro, especially in this macro climate where the US dollar is losing, let's say 5 to 7% against inflation every year, I think what could be interesting is for eventually for Terra to start to peg itself to things that are not national currencies and instead against its own price index. And I think as the crypto ecosystem matures more and Terra as an independent brand gains a lot more value, those things are going to become more applicable. But that day is not today.
Okay. Thank you. So I think we have some question from the people raise hand. I'll unmute Xing Yun.
Hi, thanks so much. I have two questions. So one is, how do you compare Terra with the other algorithmic stablecoin, like say DAI? Another is, what kind of technical and probably crypto economical preventions have you built up towards things like Soros attack, where people just try to dump the price in very fast a short period and hope the algorithmic stablecoin is collapse. So must have ways to prevent them, but love to learn about it.
Got it. So to answer your first question first, most algo stablecoins on the market are have been inspired by the Terra Luna model. So for example, like Frax and Vader and Shade. So they're quite similar, and I think they're great. They just focus on slightly different use cases, so I'll skip over those. To draw a comparison against MakerDAO, I think MakerDAO is a great project, and I think it's done a lot for DeFi. But I think it's slightly, I wouldn't call it a stablecoin so much as a way to borrow against, it's a leverage protocol in some sense. And the reason for that is because in order to mint 1 DAI, without the help of USDC, you need to spend more than $1 worth of collateral in order to mint 1 DAI. So this makes it inefficient to use as a stablecoin protocol because the cost basis to create $1 worth of stablecoin is more than $1. So it has a ceiling in terms of how much you can expand the supply of the stablecoin, because it's going to be bounded by the demand for leverage on whatever collateral types that MakerDAO supports. Now for Terra, the cost basis to mint 1 Terra USD is always $1. You need to burn $1 worth of Luna in order to mint 1 Terra USD. So from that standpoint, it has infinitely scalable expansionary policy, because insofar as you can keep buying Luna to mint 1 Terra USD, the supply is going to be, you're going to be able to expand the supply as much as you want. In terms of building up sort of resistance mechanisms to things like Soros attacks and black swan failures, we've done a number of different things. So for example, one of the things that we're creating is that we're creating a multi-billion-dollar Forex reserve for Terra stablecoins. So the idea is that there would be currencies like, there would be other crypto assets, mainly Bitcoin, against which Terra USD can be redeemed during times of economic contraction. So in some sense, this is quite analogous to how FX schemes of most nation states are operated. So the US government doesn't have this, but for example, let's say Singapore or Korea or Japan have Forex reserves that can absorb short-term volatilities of the demand of currencies. And this is to make sure that economic activities such as exports and imports are not impacted by rapid drawdowns and changes of foreign exchange rates of their national currencies against, let's say, the US dollar. So it's doing that, but setting that up in a decentralized context whereby not only can you redeem Terra USD against Luna, which is the core stability mechanism, but now you would also have third-party assets against which you can redeem your USD at a given time. So it builds up market confidence and adds further collateral to the Terra Luna ecosystem.
Right, thank you. Next one is Tyler.
Hey, thanks so much for being with us today. Terra is an amazing project. It's been really cool to see, with all the doubts about Tether, to see algorithmic stablecoins in the limelight. I was curious about lending and kind of what you see as the future there. So as I see a lot of the yield that's happening in crypto right now, the crypto economics are sort of saying, hey, everyone's coming into the market, money's coming in, and so we can distribute new tokens, create property for nothing, and reward users that way. But eventually, crypto is going to be fully mainstream, and it's not necessarily, it's going to be deflationary if you sort of still have those yield APRs. And so that kind of begets a question of, well, what is lending going to actually be doing that is sort of adding value? And so my question here is, do we see lending as potentially in the future having a role as something like commercial paper or some other sort of really important social or corporate function beyond just sort of enabling leverage speculation?
Got it. So I feel like those are two separate discussion points, but in terms of the first, I think adding a circuit breaker is almost always better if you do it in an automated algorithmic way. So people need to be able to understand the rule sets by which the circuit breaker is going to kick in. In fact, when a market is crashing and then a circuit breaker is arbitrarily injected by financial regulators, that's actually one of the most frustrating things that you can go through as a trader. So I feel like, if you had concrete rules, like for example, if the market drops by more than 30%, you're going to cease trading. Or if it goes up by 30%, you're going to cease trading. Those are transparent rules that are almost always better if they're codified in a smart contract instead of just forward declared by regulators and violated from time to time. So I think from that perspective, like adding in safety mechanisms around financial trading is something that crypto can uniquely do better than centralized and intermediated financial markets. In terms of whether crypto can mature to something beyond Ponzi-nomics and just speculative capital, let me just give you an example of something that I've been thinking about that I think is going to be really interesting. And this is how to build under collateralized lending, so basically credit markets on top of open source developers, on top of the labor market for open source developers. So for one, we are starting to see a lot of DAOs, like in your perspective, like crypto projects that now have either tens of billions of dollars or billions of dollars in their treasury. But the thing is, like, most of this treasury is just sitting there and not actually doing anything. They're mostly operating at the scale of, let's say, Series A startups with a headcount of 30 people or 50 core contributors that are just scrambling to try to do interesting things, but not really being able to move at really rapid velocity. So I think something that can be interesting is a scheme whereby open source developers can put their hours up for sale. And then let's say a DAO, let's say the Avalanche DAO, can go out into the wild and say, hey, look, I would like to buy 1 million hours worth of open source developer time. And then you guys can build interesting things on Avalanche. And this aligns incentives really well, because what Avalanche really wants is for developers to build new things on top of their ecosystem. And what developers want is to be fairly compensated for the open source of their work that they're doing in an ecosystem that they believe in. Now, not only does this create credible labor markets that is purely governed by on-chain contribution, but it also has an interesting side effect in the sense that you now have units of value with proven, shall we say, exit liquidity that is trading against automated decentralized exchanges. So what you can do is that instead of collateralizing your loan position in Bitcoin or Ethereum or Luna, you can now put up your future hours for sale and put these things up as collateral in order to borrow money. So in essence, your borrowing gets to future productivity and your future cash flows, much similar to how you would be borrowing against, like in a traditional credit market. So in that sense, this is a pivotal point
Because once we're able to do something like this, you transition DeFi from a purely speculative vehicle into something that allocates capital to the most productive areas of the crypto economy. In this sense, in this case, open source developers that build interesting infrastructure on top of blockchains. So, I mean, I think there's a number of things that are being worked on behind the scenes like this, as well as many other efforts that enable types of use cases that not only are productive, but are uniquely productive in crypto. So it enables use cases like, for example, creating a new business model for open source developers that today, quite frankly, are not fairly compensated. So in terms of like the ability for crypto to become productive over time, I am incredibly bullish. I am spending lots of our resources into making sure that this vision becomes the most likely probability. And I think the future is bright in this regard.
Awesome. Thank you. Aaron?
Hi, thanks for your time today. Appreciate that you've come here to talk with us. I wanted to ask a little bit more about credit scores, and I think this actually dovetails into the last question. We've touched on various forms of DeFi lending, and especially some of the new possibilities that Terra opens for under-collateralized loans. However, when you look in a traditional finance system, loans are typically based on credit scores and other metrics. And these metrics are all tied to a person's identity, for example, maybe by a social security number. How do you see decentralized identity evolving so that you can have a meaningful credit score to somebody who maybe has multiple sets of private keys? Or do you see some sort of system evolving where everybody can be anonymous and everything is focused on each individual key? And what about credit rating or reputation systems for smart contracts or other programmable systems?
Yeah, so that's a great question. So I see a number of different metrics. So I don't think there's going to be one unified credit score. I think there's going to be different scores for different types of use cases. So for example, so like one of the trends that I'm watching most closely is this economic flywheel that's been enabled by airdrops. So what I mean is there's basically every crypto project airdrops their initial genesis distribution to users. So they either pay a straight up, retroactive acquisition cost, or number two, they use some of their emissions to keep around users around certain types of activities. So it could be like providing liquidity to an AMM, or it could be like, I don't know, performing certain types of transactions. So like DYDX. But I think what they actually should be doing is that they should be monitoring on-chain scores for specific types of loyalty. So for example, when an NFT project is adding a wallet to a whitelist, they should look at this wallet's previous history of having held or dumped previous NFT airdrops. Or for example, if you're a DeFi project and you're doing, genesis distribution for like your fungible tokens, then you should give towards wallets that not only A, hold on to these tokens, or number two, use these tokens to actually participate in the protocol, use it in governance, use it for whatever transactions that benefit the ecosystem. So what I'm starting to see is that for a lot of the upcoming distributions, there's starting to be an economic flywheel formed whereby projects are starting to target wallets with desired behavior. And some of these projects are starting to forward declare what types of metrics that they're going to be looking for. And then in that case, how the flywheel is created is projects are going to start to spend more and more time targeting airdrops and wealth distribution towards wallets that exhibit positive behavior for whatever outcome that they want to achieve. And then you're going to start to see wallets that are curating their on-chain behavior to be aligned with that, wealth incentive. So once you have that, you're going to start to see a granular distribution of wallets that exhibit good behavior for various different types of use cases. So for example, when MakerDAO is ordering liquidations, you can start to look at things like, what is the marginal propensity of this liquidator to hold on to beta risk after they get it? So i.e., when they buy the ETH at a discount, are they likely to dump it immediately in order to close the arb? Or are they willing to tolerate the beta risk for a little bit longer, thereby benefiting the overall Ethereum ecosystem? Or like an NFT mint can start to look at things like, what is the total size of this person's collection? So it's not dissimilar to how in traditional art markets, like a dealer would ask questions like, oh, what are the paintings currently in your collection, before they offer you, like good deals on primary and secondary works and things like that. So I think a lot of that activity whereby incentives are aligned closely towards between the ecosystem and the participants are going to start to form. And I think for sure, there can be scores and on-chain analytics that are built around optimizing good user behavior around loans as well. So it can be maybe some combination of factors, like, for example, like what is the user's willingness, how long has the user created scores across these array of metrics over the last few years and things like that.
Awesome. Thank you. Diego? Yeah.
Thanks, Kun. Thanks, though. Kind of a two-step question here. What regulation or lack of regulation allows Chai to, work as a service, works a payment service in South Korea? And what regulation or lack thereof would enable it to work, let's say, in a country like Spain or wherever, right? If the question makes sense.
Yeah, so, with retail payments, like the average ticket size of a purchase in Chai, I think is around like $13, $15 today. So largely, there's pretty clear guidelines around what payments companies need to do. So for example, like in Korea, for instance, I think Chai needs to hold over, they need to hold 15% of user top-ups, 50% or above in user top-ups in cash, so available for withdrawal. So there's a reserve ratio requirement. And secondly, they need to guarantee redemptions. And three, they need to abide by capital controls, so they can't facilitate cross-border transactions quite yet. So, I mean, there's like pretty clear rules around like retail payments that are quite simple to abide by. Now, where regulations get tougher, I feel like, is around like investments or large ticket purchases. And once you get there, then you need to look into things like getting a banking license, or let's say a Forex broker license and things like that. But for like a $15 purchase, there's like a number of different apps that are doing it. Korea is like one of those unique countries where like more than a third of the population trade crypto. So regulators are quite friendly, or not friendly necessarily, but quite familiar with how crypto works and what needs to be done and things like that. So I feel like there's a lot more clarity than what there might happen to be stateside. I don't know about Spain.
I think Ching said has a follow-up question. So,
Oh, hi. I really like your comments on the deposit developers' future time as a way to have credit and have say credit-based uncollateralized loan. I wonder, it's kind of similar to why it's harder to do credit score in traditional way. In crypto, people are anonymous in some sense, and it's very hard to enforce, right? I might be a famous developer and I have reputations, but still I can just promise a good fraction of time that I never deliver, which even happens a lot with famous professor in academic. Wonder, how do you view this type of enforceability issue? Since I think this is probably the core of why it's hard to have a credit-based loan in DeFi, both in monetary sense or even in this time sense. Love to hear how you thought about it.
Yeah, that's a great question. I would say though, in order for you to be able to take out a loan, your time tokens need to have value, in the sense that there is an employer, or let's say a DAO, that is consistently buying your time tokens in exchange for something with exogenous value, let's say the Avalanche token. And the way that I think about a lot of these like DAO-based purchases, spinning out over time, is that they're going to have a longer time preference than traditional employers. And that's because a DAO cannot flexibly make a decision to terminate somebody as quickly as, let's say, a centralized company can. So likely when they purchase time tokens, they're going to be doing it over, let's say, a 6-month contract or a 1-year contract. And they're going to be evaluating your work on the basis of that time horizon, instead of, let's say, like a fickle startup, which might go bankrupt in 2 weeks, or they might fire you after 3 months or something like that. So what that means is that, like, when your time tokens are being purchased, they're being done in an automated sort of way by a DAO. And over the time horizon in which they're committing to, buy your tokens, then in that case, they're going to have exogenous economic value. Then in that case, like, even without the credit score, it can be used as collateral for you to be able to borrow money. Now, there is a question of enforceability. And I think in the beginning, enforceability is going to be terrible. So if you look at some emerging markets, like, for example, Mongolia, like, it's actually, if you can get like a 40% interest rate on your loan, that's actually a pretty good deal. Like, you can actually get, like, even if you had to pay like 60% interest on your loan over the course of the year, it's not unheard of, and it's not crazy, right? And that's because, like, the ability for people to pay loans is quite low. So in a lot of emerging markets, enforceability and risk and default risk is actually quite high. But that's just something that you sort of eat up in early markets as these systems form. And I think correspondingly, the APRs for issuing some of these loans are going to be high as well, that are adjusted for that type of risk. And I think as on-chain history builds and people start to value the chain history that they've built around each wallet, which I think is starting to happen a lot more than it used to, let's say, just a couple of years ago, then I think that risk is going to come down, and so will the cost of borrows on average.
Cool. Thank you, Bill. Actually, we have several questions from the chat. Some folks might not be able to unmute themselves. The question I see is actually from Santiago. Actually, he raised his hand. Do you want to just go ahead and ask a question?
Sure. Thank you very much for coming, though. I wanted to ask, I'm from Colombia, and I see the crypto ecosystem booming, and also with Terra. And I wanted to see your perspective on what are the most efficient and successful applications that you see that will happen in the future that will create more economic development in emerging markets like Latin America.
Mm-hmm. Yeah, that's a great question. So one of the reasons why I'm really interested in cryptocurrencies and blockchains in general is I think it's going to lead to a great migration of human activity from the real world to the internet. Now, this sounds super dystopian, but it has a number of different benefits. So today, most people keep most of the economic activity in the real world, and there's very few business models that are possible on the internet. And the reason for this is because on the internet, there isn't a conception of property value or property rights, right? Because there's no way to enforce digital scarcity. So if you look at like the set of properties that, let's say, a billionaire has on the internet and a middle school student, it's going to be exactly the same. You're going to have the same Twitter profile. You're going to have the same LinkedIn. You're going to have, everything's the same, which is why there's traditionally been only one business model on the internet that has stood the test of time, and that is advertising, right? So for this reason, it's only sort of allowed a narrow set of people to spend most of their time online. So either very niche service providers or people that work at Google or Facebook, and then most other people spent sort of constructed their economic realities in the real world. So now the problem with this is that if you keep most of your assets and you do most of your economic activity in the real world, you are exposed to that real world risk. You are exposed to geopolitical realities, like, for example, income disparities between different countries, or let's say the lack of infrastructure for you to be able to either build companies or access capital markets or things like that, which I would assume that opportunities for that are less in South America than versus Silicon Valley. Now, once we have fungible and non-fungible tokens that are animating and enforcing property rights across the internet, it now becomes possible for us to be creating economic realities purely on the web without having to build lots of things in the real world. So for example, for Terraform Labs, we have almost no assets whatsoever that exists outside of the internet, right? Like it's just like, it's almost like a figment of the imagination that exists purely online. So, from that perspective, like I think it's going to be one of the great equalizers, because it's not going to matter where you're based, or like people don't necessarily even need to know your identity, right? Like you can work for a DAO, you can work for organizations that don't really care where you're working out of, like where you happen to be based, and they only care about what you can do in front of a screen with your coding abilities or the ability to build communities. And I think that's going to be one of the great equalizing things that Web3 can bring to the world, in the sense that it's going to exploit the fact that talent across the world is equally distributed. And I think there's going to be fewer centers like Silicon Valley where there's outsized opportunity, geographically speaking, compared to the rest of the world.
Thank you. Armando?
Yes, thank you, Do and Ali, for being here. I was wondering if you have any recommendations for people who are looking to start building applications, and any like differences you think they should have in mind regarding like just developing with normal non-stable coins, like any specific things we should have in mind with stable coins.
Okay. Well, so for one thing, I noticed that you're in Mirrorlease, which is freaking awesome, because that's where I was. But okay, so here's a potential idea that I think somebody can pick up. I think it's low-hanging fruit, and I think it could be worth. I think it's something that's going to pick up a lot of traction very quickly. But one of the problems that exists today is there's multiple different chains, right? So there's Ethereum, there's Terra, there's Solana, there's Avalanche. So some of these assets are now being bridged from one chain to another. And in some cases, multiple different bridges exist for the same asset. So for example, if you go to Saber, for instance, which is the dominant stable swap protocol in Solana, there's like 5 different versions of USDC. If you go to Curve on Ethereum, there's like 3 or 4 versions of UST that's been bridged over from Terra to Curve, right? Same for BSC assets or Ethereum assets that have been bridged over to Terra as well. So this is a user experience problem, because users are not sure of which asset or which bridge is being used when they're interacting with a cross-chain asset on different chains. Now, an easy way you can solve this problem is that you can build a bridge wrapper on all the chains, all the major chains in which cross-chain assets live. And then so this bridge interface, bridge wrapper, can take in a bridged asset and then issue a canonically consistent asset interface across all the chains. So the end result would be, if you wrap a bridged asset, there would be one version of UST on Ethereum, one version of USDC on Solana, one version of Tether on Avalanche. So using this, you can create canonically consistent assets that prevent liquidity from fragmenting, prevent user attention from fragmenting. And I think this is a big opportunity, because as like in the fairy tales of old, how there were multiple different bridges and trolls used to live under bridges, like extracting rents from weary travelers. This is exactly the same thing. If there are a lot of economic values flowing through bridges, he who controls the end user experience of issuing the canonical asset can find ways of charging value from that service.
Thank you. Alex?
Oh, hi. Thanks. One question I had was, Do, previously you were talking about like uncollateralized loans and how maybe your chain history can help with that. I'm pretty new to crypto, so this might be like an uneducated question, but I've heard like a lot of Bitcoin is no longer available because people lost the keys. Could that be a concern with chain history as well? Like people lose their private key, so they no longer can be associated with the history they've built on the chain?
Yeah. So I think a naive answer there would be, as more and more people get comfortable with self-custody, the propensity by which they lose their keys is going to go down. So that's the naive answer. But secondly, yeah, I think it is a problem in crypto that there's such a high risk and cost to self-custody that we need to consistently, build new infrastructure and tool sets to help people not encounter this problem. And, I think for people that have sort of a preference of relying on recovery mechanisms and things like that, I think there's starting to be a hybrid custodial and non-custodial
models where there are ways in which you can recover your keys. So for example, like using your biometrics, for instance, to recover keys, or like it's your social login, but the key to sign into the login is distributed across like multiple different nodes. So I think there are ways in which like people are finding it easier and easier to do self-custody. We are not at a phase where those solutions have reached the right trade-offs yet. But I think over the next like 3 to 5 years, that's definitely going to be a lot less severe of a problem than it is today.
Thank you. I actually have a question. I think stablecoin or stable, the word stable is relative, right? If we're pegging like US dollars, but then US dollars kind of like US economy is inflationary, right? There's a lot of inflation. Then I'm wondering if what's your thoughts, or even like Terras like experiment bit there too, about like either like a stable coin that's pegged to multiple assets, or a stable coin that actually take the a consumer price index into consideration.
Yeah, so that's a really good question. And I think the truth of the matter is for the short term, so people's confidence in currencies is not really like a continuous gradient. I think it's sort of like a step function, right? So up to some extent, people are willing to accept inflation and high volatility relative to purchasing power. And then at some point when people's confidence breaks, that's when people hate it altogether. So I think the dollar is still in that phase where people complain about high inflation, but it's not so large enough that people are willing to start to denominate their net worth and their spending power in other mediums of exchange. So I think until we get to that point, I think pegging to something like the US dollar for Americans, or let's say the Korean won for Koreans, or the Singapore dollar for Singaporeans, leads to the least psychological resistance to adopting stablecoins. And I think later at some point where this sort of sovereign violence of printing as much money as possible becomes too unbearable, that's the right point in which we should peg to something that is community determined and is a lot more fair and algorithmic.
Awesome. Thank you, Joe. Natalie, for coming here today. I know we're almost on top of the hour. Just wondering if Natalie and Joe do have any like last words to share with the Stanford student group.
Yeah, I think for anybody, for anybody who's looking to learn more about Terra, thinking about working in Web3, or wanting to build a project on Terra, please reach out to us. We're more than happy to chat with you. And yeah, thanks for coming today. Do anything that you wanted to say?
No, I was going to say, so I think you put it eloquently.
Yeah, we're both Stanford alumni, me and Doe. So, we're always going to be big fans of Stanford blockchain and helping more Stanford people get into Web3.
Awesome. Yeah, thank you so much, Natalie and Joe, for your support to the Stanford Blockchain Club and the Stanford students. We have a great cohort and next generation of crypto founders, entrepreneurs here. So thank you so much for your time and chatting with us today. Thank you.
Thank you. Bye-bye.
Bye.